this break lower is occurring before we necessarily see the peak of bullishness.
Hi, once again, everybody. Thanks for joining us here on the Comstock channel. I'm Marlin Bohling with you. Hope you had a good Wednesday. Here to talk about Wednesday's market activity, I have Joe Camp with me, and he is with Comstock Investments. Interesting day on the markets here at midweek. Joe, looking at the grain trade, a little sell-off today, but I don't know if it was really overboard. Had some big whipsaw action taking place in the livestock trade today. And big things going on as well, like with the bond market, the interest rate prices really bouncing around. The equity markets were kind of in a tizzy. The precious metals were making moves. So there's quite a bit to talk about here today. I want to begin here, of course, talking on the grain trade here. A little bit of a weaker note. Now, earlier this week, I thought they were talking about weather premium in South America holding up the beans. What happened to that talk?
That was certainly the case last week. The focus on the meal market and its link to Argentina, projected to be the world's top meal exporter again in the 2025 season, but estimates for crop production coming down. You have a real big dry spell to deal with in Argentina, plus hot temperatures. But it was last Friday, before the session started, that we had started to see some rain enter into the longer term forecast, or I should say the medium term. It was 12 to 15 days out. Right now, that puts us to about January 15th that they remain in store for some rain chances down there. And it's a wait and see, like it always is when you promise rains, the forecast at least a couple of weeks out. They could very well miss those. To see those rains fail to materialize, I think would rile up the speculators again on that subject. For now, though, it's definitely evident in the way that the meal has taken a step back. You shifted the attention back to the soybean oil share as part of the renewable diesel conversations and all that's going on with competing oils like palm oil or canola, used cooking oil is a subject of conversation right now. So as you mentioned, there's a lot of moving parts here. Ultimately, though, rather quiet in the grains and undecided or tentative because we've got these traders, one, factoring in the nervousness in the outside markets, but also just wanting to get towards Friday and having the fundamental guidance from our next big USDA crop report.
So what do you expect to see in that report? I mean, typically on January's WASDE, do we normally have big changes or not?
Oftentimes we can see minor adjustments to the yield, but that's also the point of firework potential, because you've got a month off in November where we did not have a relook at last year's corn and soybean yields. Those are up for revision. It's called the January Final Summary Report. And given that the November yield cuts were as sizable as they were, particularly soybeans, that's going to be the expected trend. So I think I'd jump along with where the average trade guest is seeing these yields, which is down fractionally from that November update. There's a lot of other big components of the January crop report, though. It's not just one crop report. It is that January final summary where the government analysts could adjust yields for last year and or acreage. It's also a report where they bring out grain stocks and update us on what's left over as of December. We look at the disappearance or the indications on demand. They can also say something related to the last year's crop yields, as again we know are a subject of importance for this report. Beyond that, we'll stay here at home and the domestic wheat crop. We're going to have winter wheat seedings estimated for the first time this season. And then the normal WASDE report, world numbers that are very topical right now when you look at all of the focus paid to South America, Brazil, and Argentina. Those production and trade numbers can change. Same for the Black Sea players, Russia, Ukraine. A lot of numbers that could pop up and give us a surprise here come Friday, which is why these traders would maybe want to be inclined to step to the sidelines in a bigger way and then be ready to react, as opposed to come into the new year and take real big conviction-based bets, which we haven't observed as of yet.
It'll be interesting to see what kind of changes they make to South American production estimates, given the fact that last year they never did really agree with what CONAB had.
Nor the year before that. And so we leave that open as a extended possibility that the USDA will not be on the same page as not just the public, but CONAB, Brazil's crop agency, or even to some extent, USDA's own satellite offices in Brazil. We've seen those discrepancies as well. I think the general feeling is that we do have production cuts coming for Argentina, but will those be offset by gains on Brazil? It's still the case that what stress the Argentine farmers have is largely offset by the really favorable weather reports throughout the rest of Brazil so far.
Well, looking at a daily March soybean chart, it looks like it continues to be stuck in a channel, a downtrending channel that goes all the way back to early last fall. It tested the upper side of the channel about 4 days ago, bounced back off of that again. Now it's kind of drifting lower again. Meanwhile, you look at a corn chart, March corn, and it seems like it's kind of flattened out here over the past week or two. What's going on with that?
It has flattened out, and you'd say that the soybeans and now the wheat here all of a sudden again have taken over as being more of a negative than the positives are viewed for corn, and that makes that market somewhat stagnant. It also is the case as you approach this crop report, the hedge funds, the large speculators have been, of course, relatively more friendly on the corn futures. They've got a net long position in corn futures and options. Actually, it's as big as it's been now since 2022, yet those same funds still short soybeans and wheat. So what gives? Lately, it's been more of the focus on technical weakness for soybeans, but also those fundamental influences of, well, we got weather worries in South America, but not enough yet to really take away a huge chunk of supply. And we know that supply is being earmarked for the big buyers like China as we head into a new year and have a new U.S. government administration take into office, which has been talking about those tariffs, which we know will impact the interplay between the U.S. Demand and what China is buying relative to those sources of supply ready pretty quickly now in Brazil, and then not long after that in Argentina. You have, I think technically, you mentioned the broader channels. It could be for wheat as well. We can't even get above the 20-day moving average or just that broadly based downtrend that we've been stuck in for some time. And then back to the beans in particular, for as many attempts as the buyers have had to close and hold above $10 for these nearby contracts, they just haven't been able to do that. And so there's still a very clear point of resistance in place right now for the soybeans.
Does that make you change your market strategy now for this year?
It doesn't for this year, in the sense that we've already been aggressive on the soybeans, having let go of that old crop and now pushing into the new year and waiting for opportunities on the next, which we think, are not ruled out at this point in the window of that normal seasonal rally. We can get into April, May, and beyond and have that upside similar to the way we did in 2024 that can allow some new crop marketing opportunities. For now, I think it's being glad if you've got the majority or all of the crop marketed, and you can sit back and now use that those previous sales to hedge your patience now on the next crop.
It's interesting. We were talking about the soybean chart remaining in a channel. On corn, it took forever and a day for it to get above the 200-day moving average, but Shazam, Joe, we've had corn over the 200-day moving average now for almost 2 weeks. I'm amazed. And yet I still hear talk about expected huge increases in corn acreage this year in the U.S. I'm surprised it's hanging on to that level.
It is a futures market, so more and more we're thinking about the future and the next crop and the acreage implications and the ratio between soybeans and corn and what that says about planting intentions potentially in the season ahead. But that's still a little ways out in the future. I'd say more of the tension has been old crop focused. It's been up front. It's been where the speculators have been positioned, largely in the nearby contracts, driving the move up. But as we've visited several times over, it's that interplay, I would say, between the speculative buyers and the farmer sellers that has involved these several attempts towards new highs, and then the rollover, or the rollovers following the act of farmer selling. That was the case the first time we were bumping up against 450 and that old contract high. And then you got back up there. We bought some more corn. Now we're into the month of January, holding pretty strong. There's likely to be more farmers selling. January, normally the top month for corn sales outside of November, just after harvest is wrapping up. But now all of a sudden you get to a point where, okay, that fund buying has bought a lot of corn, and a lot more corn for sure than it did a year ago. And that can be a actually friendly factor, that you don't have so much of the last crop hanging over now as we enter the new calendar year and eventually the new season ahead. So that's one thing to watch, continuing this back and forth between the speculators buying and the farmers selling. If we get past this next tranche of farmers selling that has occurred on the recent strength, we get out of January and then wait and see about all of the political stuff, the trade policy, the biofuels, all of those outstanding issues. And I think that's where we could still see some upside on corn, because the speculative buying interest may continue to outstrip the farmer selling activity. The caution here is, though, that we are seeing speculators reach a type of bullish position that historically has then proceeded to trigger short covering and at least a temporary flip towards being a bit bearish on the speculative side. That can come when you have a position that's this much of open interest right now held by the speculators. So we'll wait and see it. It's still back to what we talked about technically in my mind, where you're going to get either the corn continuing to break out, and that will be what it takes to turn the speculators more broadly bullish on soybeans and wheat, or it's going to be a failure for one or both of those other crops, soybeans or wheat, that ultimately is an anchor for the corn and disallows further upside for that market. Right now, we're maybe a little bit more negative in thinking these soybeans and wheat are in a weaker chart position, weaker fundamentally, and with corn up against, as we said, this transition into the new season. It's a let's see where we've come and what we should do about it, and manage risk now and certain ahead of this Friday's report.
Seasonally, is it time to start getting friendly on wheat?
It can be. You can see that wheat would have the potential to follow corn and soybeans higher into the spring, and then you get into the spring and wheat has more fundamental direction of its own, of course, as we take stock of how the U.S. winter wheat crop looks. By all accounts, a really good start, but a long ways to go there. It's going to be, again, right now in the immediate term, in my mind, what happens with corn and soybeans, what happens with these yields. As long as we don't have a huge surprise on the winter wheat seedings update, then it's going to be a continuation of the broader feel about grains, as opposed to wheat being the leader. Wheat can turn into the leader as we, again, get closer to the development of the winter crop and towards this spring harvest, which I guess won't be too far away now.
Well, looking at the livestock trade, a big turnaround to the downside on the cattle complex. Okay, it's only one day, but what do you read into that? Or does that raise caution flags for you here?
It does. I'll say that what you did again, that it's only one day, and one day does not make a trend. And we think back to a Friday ago, a bearish reversal on the nearby contract, and not all the way there for the most active March. We're talking about feeder cattle, which have been making the more sizable moves, really the leader technically. Oftentimes we see, though, now that this break lower is occurring before we necessarily see the peak of bullishness. And that's one of those adages we keep in mind, that the market can certainly top before sentiment is at its most bullish, or vice versa. And in this case, I say that because we talk to farmers, we see what's going on there in the auctions, the sale barns, really hot cash trade still firming up this week. But you'd have to wonder if the speculators, the overall makeup of market participants, are they wondering, is this the last sort of push, at least temporarily, for buyers to catch up after the holiday season? And that's what's been really bullish still to this point. Whereas we could have thought you get out of the holidays and there's going to be a lull. We won't have quite the same aggressiveness on the buy side that we did leading in, but yet it's a testament to how strong consumption was over these last several weeks that the buyers, packers, retailers, I mean, on every level, have to catch up like they are showing the need to in this cash trade. But again, you can push that coverage and get a lot bought in a week like this, and then be left to have a correction vulnerable next week or beyond. And maybe the speculators getting ahead of that and starting to take some profit and not wanting to be the last one out either, given that we can see those managed money folks having near record net longs on both the live cattle and the feeders. That's a big position to cover.
Well, a few things. I mean, looking at a feeder cattle chart, it has to go down about $5.50 yet before it even gets to the 20-day moving average. I mean, it's got a long way to go for that. Stochastics, well overbought on live cattle and feeder cattle. So a lot of times that'll put some resistance in the trade there. And then you always have the old adage, of course, that you top on bullish news, right?
And that's what I'm getting at, to think that there's nothing to bearish about the underlying fundamentals of the market. We know why we're up at these levels, but that doesn't mean that they're not levels, that equilibrate the market. I mean, that clear the market, that find a selling interest. And I think that was what we observed in part today. Again, not to say this is necessarily the end of it, but it could be the beginning of a turnaround, at least temporarily, to settle the market after that huge upside run. You mentioned the stochastics. You have such strong momentum, relative strength. Any indicator you look, that's representative of a real clear breakout. But then the failure on a day like today, you can start to bring up some bearish type divergence. And that's something those computer algorithms are going to watch pretty closely. If we have a break lower to new lows tomorrow, at least relative to last Friday, because that's what I'm bringing up. A lot of these contracts only back to where they settled at the end of last week. So it's been a long way up. Today's move, even as large as it seemed at points, a blip as far as being not too far away from the top.
Now, the lean hogs had kind of a so-so day. I mean, it was kind of mixed. Interesting. If you look at a daily chart on lean hogs going back to early August of last year, it looks like an escalator ride going up. Remember, a lot of old market adages where they say you take the escalator up and the elevator down. Not so in this lean hog trade. It took the escalator up, and now it's like it's taking the escalator down. It's just almost the same pattern going down. However, I'm wondering, can you make the case that there is a head and shoulders that has been built in that lean hog trade or not?
You can start to see that type of technical formation really broadly today. Speaking, there was a lot of attention paid to the 100-day moving average. We were holding that up, and then late in the session, these deferred contracts falling below that. The April, for example, we mentioned the April down, these back months weaker, but still some strength in the nearby February. Bull spread is not necessarily bearish, but it does fit more so with the fundamental guidance that we've had on the hogs lately, which is to say, still very positive about cash and demand through the winter. That latest quarterly hogs and pigs report, though, it showed us that maybe higher prices, plus that continued growth in the litter count. You've got a bigger than expected, at least slightly, pig crop, not quite as big of a reduction in the farrowing intentions going forward. So to see the nearby hold up and some selling in the back months, not a huge surprise. It's also saying that the speculators, they're going to want to try to still defend these net longs that they've built up. Actually, in the hogs, a record net long here recently in the hogs, but they're not necessarily willing to roll those positions forward past the nearby contracts here. We've observed that since the December went off the board.
Now, in these outside markets here on Wednesday, I heard a lot of talk about the bond interest rates going higher again. And that was the case. But I also see where the US dollar was sharply higher at the time we recorded this, over 500 points higher on the day. Well, that never helps ag commodities either.
Interest rates going higher, making the dollar more valuable. It's a continued look at the spread between interest rates in the US and interest rates around the world. You have the Federal Reserve rate, right? All the talk about it going lower, down 1% since it started being cut in September, yet the 10-year Treasury is up 1% over that time. So there's some questions and some worry, one about pending recession ahead, about the Fed and their ability to control the long end of the yield curve, about again, divergence in the economies abroad and what that means for continued strength, likely in the greenback, when we also have that tariff outlook at play. Normally, if you're going to charge tariffs, the currencies are going to adjust. In this case, the dollar go up and others go down to offset at least some of that new trade charge. That's definitely the case that we're seeing in China. Of course, watching that customer closely as the dollar rises, the yuan falls. The government in China failed to intervene successfully to keep it above a key mark last week. Now you have a look at Chinese interest rates as low as they've been for a long time. And it just doesn't bode well necessarily at the moment for economic confidence. And we can see that play out certainly in this stronger dollar. And you mentioned it. Yeah, strong dollar is going to hurt your terms of trade for exports. And you can see that likely expressed in even today's slightly lower muted type of negative grain trade that we're worried about what's ahead for trade demand for sure.
Kind of tells me that the financial trade doesn't believe the Fed anymore. They're trading the opposite of what the Fed is always trying to say, the way it seems.
Seems to be the case here that you think, well, they don't have any more rope to push here now that we are down 1% with inflation still as hot as it is, and the political dynamics of tariffs plus those reduced rates elsewhere around the world. It's a sort of loss of control, if you will, or the vulnerability or risk to see more of that.
Well, good to visit with you again, Joe. Thank you for all the insight into the markets here. And just a reminder to everybody, on Thursday, the markets will close early because it's in honor of the Jimmy Carter funeral that will be taking place. It'll be an official day of mourning, so the markets will close shortly after noon Central Time. And so be prepared for that. It'll almost be like the day before a major holiday. Anyway, thank you, Joe. I appreciate it. And we'll talk to you again soon. Joe Camp with us from Comstock Investments. That'll do it for this episode. Thanks again for joining us. For producer Breanne Jenkins, I'm Marlin Bohling, and we'll catch you next time here on the Comstock channel. Futures trading involves risk. The risk of loss in trading futures and or options is substantial, and each investor and or trader must consider whether this is a suitable investment. Past performance is not indicative of future results.